Hello, this is Coach Mike from winningstockcoach.com. Going to start out with my weekly market overview for the trading week ahead, the trading week that'll begin January 26, 2015. So starting out here on the SPX chart, that's our S&P 500 chart. Last week we talked about how with our weekly chart we had just a few weeks ago that little pop up to give us a higher high, which would have us making the assumption that we could make a higher low from our closing point, and we did. We talked about last week using the support of the closing value of 2002 and 33 cents for our support levels as far as the close of the week goes. As you can see, after just a little bit of a dip the first part of the week, we ended the week with a positive movement, giving us the indication that we may indeed begin to move up, and with a higher low, we would again project a higher high. And we talked about last week that higher high value being in the vicinity of 2109.11. So there's a couple important things that I want to say before we get more into the charts. And, the most important thing is the fact that this upcoming week is probably the biggest earnings week of the quarter. Like 25% of the S&P 500 will report earnings this week. So I want to take and kind of break down things on our daily chart as well. And before I do so, I want to kind of tell you that there is a little bit of a discrepancy between the daily and weekly charts. As you can see, the weekly chart's been more free flowing. We saw the low, our higher high, now our higher low. No real reason to think otherwise that we could hit this 2109.11. But if we go down to our daily chart, and I'm just going to pull it up on a 6-month time frame, you're actually going to see that on this daily chart, after that higher high was made, we actually came down. We did make a higher low, but we made a lower high and then a lower low. So if I would take the same tool that we use to project our targets, which is our Fibonacci extensions, and you can see that last pullback target we had of 1986.64, we looked to get within a 0.5%. Well, we definitely got within a 0.5% of it. But if I marked this low over here up to the high and then to the low that we saw on that last dip, you'll actually see it gave me a target point of 2060.11. Now, obviously that was broken above. But then on Friday, it closed back below it. And again, with these target points, we look for accuracy within a 0.5%, which you'd have to say we definitely did that. So here's where the discrepancy comes in between the daily and weekly charts. That weekly chart I showed you, it was very fluid, higher high, higher low, higher high, higher low. And then on the daily chart, we got a lower high and lower low, and we hit right in the area of where we could see a pullback from, which would in turn actually reshape that weekly chart and give us a lower high should we pull back from here. So when we look at those things, coupled with the fact that this upcoming week is a big week for earnings, we have to keep in mind that, if earnings sour, then they took the charts to the perfect point for them to begin to pull back to maybe reshape and set a new trend. And if the earnings are good, you're actually right there in the vicinity of a breakout point that, should we break out of, could take us to that high side target of 2109.11. So my suggestion is that in the upcoming week, you proceed a little bit with caution. If you are looking for trades, I would look for trades for stocks that have already reported earnings. For instance, a lot of the financial stocks. Most of those financial stocks missed the Wall Street estimates, fell, but over the last week actually made an up move. That's actually a good thing for traders that might be looking for a trade. If you missed on earnings and then you made an up move, then you could have an opportunity to possibly short or play put options for a new set of swings over the next quarter, to give you some longevity and give you some availability there. With most of your technology stocks still set to report their earnings over this coming week and even the next week, I would proceed with much caution with those. Most of your options premiums are very well inflated, which, could make things quite dangerous for you. And, obviously you get the rare occurrence like Netflix last week, where even though on most of your call strikes, you would have needed anywhere from a $47 to a $52 move, a gap for the next day after earnings just to break even. that even though it's been pretty similar in that way for the last 9 quarters, and over the last 9 quarters, you couldn't have made a penny whether you played calls or puts for Netflix options. This time, you could have actually made decent money. So those premiums and the inflation on them, when you factor in the size of the move you would need, many times people that are looking for those home run earnings trades don't quite understand the danger in them. And if you're trading options for the earnings, you really have to approach that with the mentality that you could very easily lose 100% on your trade. And even though you could make far beyond 100%, the fact that you could lose 100% just on an overnight move needs to leave you preparing for any trades that you might make for earnings via the options in a way that you're not trading with anything more than what you are willing to lose. And that'll keep you a little bit protected. Now, again, I just want to rephrase or restate what I had mentioned here. That discrepancy between the weekly and daily charts have us right at a point where, even though the weekly chart is set up really good for a potential continuation of the up move, the fact that the daily chart is saying, hang on just a second, I'm going to think about it here at this other resistance point, a resistance point that would indeed actually reshape our view of that weekly chart, that this week is a week where those earnings really matter. Those earnings could determine whether the market begins trending downwards, or if it continues in this solid uptrend it's been in. One thing that I tell members of the coaches roster, and we do this each and every quarter, is I don't make a lot of earnings trades. And when I do, I have a very high success rate on them, but I don't chase the ones with super inflated premiums that are extremely dangerous. But when I look at my swings that we start to develop over each quarter, we usually wait for those earnings reports, allow them to make that first little move, and then begin our swings in the appropriate direction. And it's given us a very high success rate. So again, watch for stocks that have already reported earnings. And if they've made a move that contradicts their performance on earnings, look for your opportunity, or look for that as an opportunity to enter a trade in the direction of what their earnings report was. Meaning, if it was a good earnings report, very simple. Look for a calls play on a pullback after that initial move after earnings. If it was a poor earnings report in relation to the Wall Street estimates, then look for an up move to begin a short trade based on that earnings report and the failure of the estimates. It's a very simple and easy to follow strategy that anybody can play along with. It's just about having the patience to understand that no stock goes straight up or straight down, and there will be up and down moves for every stock. So to allow those the time to make the move opposite to what you're planning for, and using that move as your opportunity to enter the trade you've planned on, is going to give you a higher success rate in your trades overall. Going to move over now to the DJI chart. That's the Dow Jones Industrial Average chart. Looking here at the weekly, and much like the S&P 500, that weekly chart is forming up pretty much the same. One thing I will point out, though, is that the weekly candle on the Dow is really not very strong. It's not a doji candle, but when I see a candle that the wicks are about equal, top and bottom, it pretty much gives me the expectation or the anticipation that I need to play it like a doji. And a doji doesn't mean guaranteed reversal. A doji means you really need to watch that next candle to get some confirmation. Now, it is true that the Dow Jones Industrial Average is a composite of only 30 stocks. I never quite understood why people say the markets when they're referring to the Dow when it's only 30 stocks. It's just 30 pretty big stocks that, it's not all the big stocks, but it's 30 big stocks and usually some older, longer longevity companies that it covers. But basically what each individual index is, if you could think of it like this, is a portfolio. And it just so happens that the portfolio that we call the Dow Jones Industrial is a portfolio that holds 30 stocks. And we're in that same boat as we were with the S&P. And, even though I don't think Goldman Sachs earnings were that bad the week before last, I still realize that they missed the Wall Street estimates. And, with IBM missing as well, which is another big Dow stock, we could really be at a point much like what I talked about with the strategy for this week for the S&P, where we are at a point when we change over to this daily chart where, as you can see, even though that weekly was making higher highs, higher lows, we come over here and we see a lower high, a lower low. And unlike the S&P, which really double topped on this last high, the Dow is really indicating that with any further downwards movement, you will have confirmed a lower high again. And if we use our same little tool that kind of helps us project target points, you'll actually see the Dow came a little short of where I would have anticipated it coming to. But if from here it does get a downwards move, we're probably going to also come really close to that other target point from my weekly chart that I came a little short of so far. Where the S&P smacked right on it, we were a little shy on the Dow of where our downwards projection was. So this might be that time where, because we were a little shy of it, it comes down and hits that. And as we look for more earnings throughout the Dow over the next few weeks, we'll see how that one really shapes out on our weekly chart. But it is so far something you got to realize that we have yet another higher high. And if we continue positive in the upcoming week, we will really be able to confirm that higher low. And with that higher low, should we confirm it, we'll be looking at 18,279.41. And like I've stated over the past 4 weeks, that if we get a lower high on our weekly, we would be looking at 16,607.93 cents as that next lower side target area. And now we're going to move over to the Russell 2000. This is our small cap index. And, kind of a flat week overall, really, for the Russell 2000, but very similar chart setup to what we're seeing with the S&P and the DJI. I can't stress enough my personal belief that because of how many stocks are reporting earnings in the upcoming week, that you really take the time to kind of let the chart develop here. I don't think the chart will get away from you if you're waiting, till Tuesday or Wednesday to really get that assumption of your overall direction. And really why I would say wait till Tuesday or Wednesday is there's a really big stock that generally has a lot of control over overall market direction, and it's called Apple. AAPL is the ticker. You might have heard of it. Largest market cap of any stock in the United States. They report earnings on Tuesday after hours. And one thing that we have seen throughout quite a bit of history in the U.S. markets is that the markets generally trend very comparable to Apple. So if Apple doesn't do well and starts to fall, we'll at least see other technology stocks falling. And if all that happens, well, then we'll probably see other U.S. stocks falling at least a little bit. And it'll give us a different viewpoint on the current trend. So for me, knowing the effect that Apple's had in the past on the markets, I have no problems waiting until Wednesday morning to really solidify my assumptions and overall market direction. And I would do the same thing for small caps, even though Apple does not trade within the Russell 2000. I would do the same thing for the small caps just because the sector-based momentum that can be created by a stock, and there are several technology stocks within the Russell 2000, can be something that, regardless of how good your stock is, if the markets overall, if the indices in general are pulling that stock to the downside, it's going to fall with it. So a little bit of patience early in the week definitely is what I think is in store. And now we're going to move over to the NDX. This is the Nasdaq 100. Last week I did talk about this lower high that was made on the weekly and then the lower low and how it gave us a projection point of 43.1220. And as you can see, we've nearly come to that with Apple's earnings being on Tuesday. And I also said that if we broke that 43.1220, that we could actually make a momentum trade, a breakout trade that could eventually lead us up to 47.2571. Now, what's really important to understand, and I alluded to this earlier when I said the index, each individual index is really like a portfolio. And the movement that you see in the index is basically an averaging, just like your account would do, your own brokerage account. If you owned each stock that was contained in the index, your up and down overall would basically look just like the index chart does. And one thing that's a little different with the NDX than some other of the indices is their proportioning. It's not just an even proportioning through each stock by amount of capital. It's broken down a little different. And actually, one really, really popular way to play Apple's earnings, which I mentioned also in this video, is actually through an ETF called the Qs. The QQQ is the ticker. And what that is the tradable ETF for the Nasdaq 100, which actually is 13% Apple. Apple is the largest holding in the Nasdaq 100. So many times when you see super inflated options premiums on Apple going into the earnings, even though the Nasdaq 100 or the Qs will have those same of a little bit of a premium inflation, it's not to the extent of what the premium inflation would be on the individual equity of Apple stock. Many people will actually play Apple earnings through the Qs. And even though, if Apple makes some $50 gap up and, the Qs is probably not going to replicate that huge of a gap up, you could make some huge amount on Apple options. You also, with the Qs, don't always have the same risk that you would have should you be wrong in trading Apple's options for the earnings. So again, it's a very popular thing, very common thing for people to trade their earnings trades for Apple via the Qs and actually not individually on Apple itself. And when you look at that overall, I'm basically led to believe that come Tuesday afternoon, if Apple beats on earnings, it'll probably break above this 43.1220. It might even break it on Monday or Tuesday before the earnings, but I'm not really going to buy unless I see the earnings. And the reason for that is I don't think it would break by much. And once I see the earnings, if the earnings are good, I think it could continue one heck of a long way. So even though I'm not going to try to get the lowest possible price on my buys, I'm going to try to buy at a time when I feel it's more secure and I have a higher probability of producing the winning trades. So again, just to kind of put everything in summation for the upcoming week, the markets are at a very, very critical point. There is quite a discrepancy between your daily and weekly charts for the US indices. Those discrepancies are pretty clear on every one of the indices I cover in this video, except for the NDX, where you have a very clear view of higher highs and higher lows. That exception for the NDX being that you can see a lower high and a lower low on the weekly chart. But with the other indices showing a very, very distinct higher high, higher low pattern on the weeklies, yet their dailies have altered and become somewhat different, we have to look at another similarity, which is in the fact that usually, even though it'll seem like the NDX on a day-to-day basis will lag the DJI and the SPX by 1 to 2 weeks, when you look at the weekly charts in general, you'll actually see that it's the DJI and the SPX that lag the NDX by 6 to 8 weeks. So as far as the short-term up or down moves over a daily chart basis, yes, you could see what visually looks like a bit of a lag where the NDX is following behind the S&P 500 and the Dow Jones Industrial Average. But in reality, in the longer term, by about 6 to 8 weeks on average, it's actually the NDX that leads the SPX in the DJI. So let's look at something really quick. Last week being 1, 2, 3, 4, 5, 6. That was right at the time that we came up and made our lower high. And it's the exact time I'm telling you to look where we're at a critical point on the DJI chart and on the SPX chart that even though it doesn't look so now, could very well reshape to give a lower high and lower low. And we see that when we put in comparison the NDX to the DJI or the SPX, there is that 6 to 8 weeks worth of lag on the average to the weekly chart. Very, very interesting as we approach the largest earnings week for U.S. equities. This is Coach Mike from winningstockcoach.com, encouraging you to always have a plan for your trades and trade according to that plan. Make sure you are entering your trades or even planning your trades with risk in mind. If you focus on the risk, the rewards will take care of themselves. God bless you in the upcoming trading week and the best of luck.